While your bank balance may grow in numbers because of interest, it often fails to grow in real value. Inflation quietly erodes purchasing power, and when bank interest lags behind rising prices, cash savings lose ground every year. According to For Wealth Financial Group, if the interest rate on a savings account is lower than the inflation rate, the money in the account loses value. What looks like growth on a statement is often slow wealth erosion in real terms. This is how wealth disappears without most people realizing it. In this video, we'll break down 7 asset classes that behave differently. Assets that aren't dependent on bank interest, can't be created at will, and have preserved real value through inflation and currency debasement. To understand what actually survives monetary failure, we start with the first asset. Asset number 1, precious metals. Precious metals have held value for thousands of years because they combine physical scarcity, durability, and universal recognition that long predates modern banking. Long before fiat money existed, gold and silver functioned as money and stores of wealth across civilizations, from ancient Egypt and Rome to the Silk Road, because they were difficult to produce, hard to counterfeit, and widely accepted. Even after the gold standard ended, their role persisted because their value is rooted in limited physical supply rather than any single government's promise. The reason precious metals preserve wealth is mechanical. Gold and silver cannot be printed. Their extraction requires time, labor, and capital, which limit supply. When fiat currencies weaken through inflation, monetary expansion, or geopolitical stress, precious metals remain liquid, globally tradable assets whose prices rise in currency terms as purchasing power falls. This pattern has repeated throughout history and continues today. In the modern era, gold and silver have repeatedly acted as safe havens during financial stress. After the 2008 financial crisis, central banks increased gold holdings to hedge currency risk, a trend that accelerated again in the mid-2000s as countries like India, Turkey, and Poland added to reserves amid rising uncertainty. During this period, gold reached new nominal highs, while silver experienced sharp volatility, reflecting both monetary demand and industrial use. Gold and silver do not behave identically. Gold's role as a central bank reserve asset makes it less volatile and more consistently viewed as long-term monetary protection, while silver's significant industrial demand can amplify both gains and drawdowns. Across centuries, however, the pattern remains the same. When trust in paper money erodes, precious metals tend to preserve real purchasing power because they're anchored to physical scarcity and global acceptance, not political discretion. Asset number 2, industrial commodities. Industrial commodities have supported economic development long before modern financial markets because they are the raw materials of civilization. From early tools made of copper and iron to the industrial revolutions that built railroads, factories, and cities, physical materials have always driven economic activity. Unlike currency, whose value depends on policy decisions, industrial commodities derive value from necessity. They are essential inputs for infrastructure, transportation, technology, and energy systems, anchoring demand in real-world use rather than speculation. Their ability to preserve wealth comes from basic supply and demand. Metals such as copper, aluminum, nickel, and cobalt require large amounts of capital, labor, and time to extract and refine, which limits how quickly supply can expand. When currencies lose purchasing power, commodity prices tend to rise in nominal terms to reflect their unchanged real value in goods and labor. This relationship has appeared repeatedly throughout history and continues today because these materials are priced globally against real economic activity. In the modern era, infrastructure expansion and technological transition have intensified demand. Investment in renewable energy, electric vehicles, battery storage, data centers, and power grids has increased reliance on metals that cannot be easily replaced. Copper, in particular, has shifted from a cyclical input to a strategic asset because of its central role in electrification, with demand projected to outpace new supply. While short-term speculation can create volatility, real industrial demand ultimately reasserts itself. Across centuries of industrialization and into the current energy transition, industrial commodities have remained indispensable. Their resilience comes not only from scarcity, but from their enduring role in building and sustaining modern economies. Asset number 3, stable foreign currencies. Stable foreign currencies preserve wealth differently than metals or land because they work through relative strength. If your home currency weakens, you don't need the perfect currency. You only need one that weakens less, holds trust better and attracts capital when fear rises. In modern markets, the US dollar, Japanese yen, and Swiss franc are most often described as safe havens because they have repeatedly gained value during periods of financial stress. The Swiss franc is the clearest real-world example. Switzerland's long-standing political stability, strong institutions, and conservative monetary policy have made the franc a destination during global turmoil. Research consistently identifies it as a safe haven currency, and during the Eurozone debt crisis, it appreciated so rapidly that Switzerland imposed a minimum exchange rate against the euro, an extraordinary step that showed how powerful safe haven flows can become. That episode revealed an important truth. Even safe currencies can become too strong for their own economies. In 2015, the Swiss National Bank abandoned the exchange rate floor, not because the franc lost its refuge status, but because defending it had become unsustainable. Since then, the franc has continued to behave as a haven, though not perfectly in every crisis. During the Credit Suisse shock in 2023, for example, its gains were more muted, reinforcing that safe haven is a tendency, not a guarantee. Still, the broader pattern remains. Reporting in early 2026 again grouped the yen and Swiss franc alongside gold during a global risk-off rally, echoing the same behavior seen in past crises. Mechanically, this asset class is about avoiding dependence on a single currency. Bank balances can rise while purchasing power falls, but holding stronger currencies can preserve relative value when weaker ones are being debased, because in global markets, trust is repriced every day. Up to this point, every asset we've covered shares one thing in common. They reduce reliance on any single system, currency, or promise, and that becomes even more important as we move deeper into how the financial system actually prioritizes survival. Asset number 4, government securities. Government securities preserve wealth not because they defeat inflation, but because they sit at the top of the financial hierarchy. A government bond is a claim on the taxing power and legal authority of a sovereign state. Throughout modern financial history, this distinction has mattered during crises. As capital consistently moves toward obligations issued by governments capable of enforcing laws, collecting taxes, and controlling their own currency. Sovereign debt dates back centuries, with European states issuing bonds as early as the 17th century. In the United States, the Treasury market expanded rapidly during the World Wars, establishing government bonds as the closest thing to a nominal, risk-free asset. This status emerged not because governments never struggle, but because strong states prioritize debt repayment above nearly all other obligations. The mechanical reason government securities preserve capital is straightforward. Governments that issue debt in their own currency cannot be forced into involuntary default in the same way households or corporations can, because they control the currency used for repayment. While inflation risk remains, default risk is dramatically reduced. Historically, investors have accepted low real returns on government bonds in exchange for legal certainty and liquidity during periods of stress. This pattern has repeated across crises. U.S. Treasuries held value during the Great Depression, attracted massive demand in 2008 despite the crisis originating in the United States, and again became the primary refuge during the market panic of March 2020. In each case, safety mattered more than yield. Recent years have added nuance, not reversal. Rising debt levels and political disputes increased volatility, but sovereign securities have remained the system's anchor. Even in the mid-2000s, U.S. Treasuries continued to function as the world's primary collateral asset, with strong demand for short-term bills during periods of uncertainty. History also shows that not all government bonds are equal. Definition: alts in countries with weak institutions or limited monetary control, such as Greece after 2009, underscore why credit quality and currency sovereignty matter. Within a wealth preservation framework, government securities act as shock absorbers rather than growth engines. They may not protect against long-term inflation alone, but they have repeatedly preserved capital when private promises failed. Asset number 5, value stocks and dividend funds. Value stocks and dividend-focused funds preserve wealth in a different way than metals, currencies, or government bonds. Their value comes from ongoing productive activity. They represent ownership in companies that produce essential goods and services, generate consistent profits, and return part of those profits to shareholders. When currencies weaken or financial systems strain, businesses that continue operating retain intrinsic value because their earnings are tied to real economic demand, not monetary expansion. This difference becomes clearest when speculation collapses. In the early 20th century, markets were dominated by industrial firms, utilities, railroads, and resource companies with tangible assets and steady earnings. During the Great Depression, many speculative stocks disappeared, while essential businesses survived and later resumed dividends. The same pattern repeated after the technology bubble in 2000, when unprofitable growth stocks collapsed, but established firms in energy, consumer staples, and materials preserved far more purchasing power. The mechanics are simple. Companies that own factories, infrastructure, or power systems generate cash flow regardless of currency changes. When inflation rises, many can raise prices, allowing revenues to grow in nominal terms, even if real demand stays stable. Dividends add resilience by providing direct cash returns that do not depend on rising share prices, a feature that proved especially valuable during inflationary periods like the 1970s. Recent history reinforces this pattern. After years of low interest rates following 2008, speculative growth investing flourished. When inflation surged and policy tightened in the early 2000s, many growth valuations fell sharply, while firms with established earnings, strong balance sheets, and reliable dividends proved more resilient. Value stocks and dividend funds ultimately represent ownership in systems that keep functioning, and that foundation has preserved wealth through inflation, recessions, and monetary change. Asset number 6, land and real estate. Land and real estate preserve wealth through one of the oldest economic mechanics in history, finite supply meeting permanent human demand. Unlike financial assets that can be created endlessly, land is fixed. No policy, technology, or financial system can create more of it. At the same time, people will always need places to live, work, store goods, and conduct economic activity. This imbalance has made land a store of value across civilizations long before modern currencies existed. Historically, land ownership has always represented wealth and stability. In agrarian societies, it produced food. In feudal and early industrial economies, it conveyed power, security, and control. As economies evolved, land remained central because every stage of development still required physical space. Cities expanded, infrastructure clustered, and economic opportunity concentrated in limited locations, reinforcing land's value even as currencies and regimes changed. Real estate protects against inflation because prices and rents adjust upward as currency loses purchasing power. When money weakens, construction, labor, and replacement costs rise, and property values increase in nominal terms to reflect that change. This pattern appeared clearly during inflationary periods like the 1970s, when cash lost value while real estate prices and rents climbed. Modern real estate adds resilience through income. Rental properties generate cash flow tied to real economic activity, not financial markets. As wages and prices rise, rents tend to follow, while fixed-rate debt becomes cheaper in real terms, allowing inflation to work in the owner's favor over time. History shows both risk and durability. The 2008 housing collapse was severe, but it was driven by leverage and speculation, not by land losing relevance. Once excess cleared, values recovered and surpassed prior highs because population growth and limited supply reasserted themselves. Real estate continues to benefit from structural demand drivers, such as population growth, urbanization, and economic clustering. Demand shifts over time, but it does not disappear. For those who don't want direct ownership, REITs provide access to real estate income and long-term value without managing property. What ultimately distinguishes land and real estate is that their value is grounded in physical reality. People cannot opt out of needing space. As long as societies exist and currencies evolve, land remains essential, and that permanence has preserved wealth through centuries of economic change. Asset number 7, collectibles. This final asset works differently from the others because its value comes from being one of a kind, not from usefulness or general scarcity. Vintage cars, rare art, limited luxury items, and first edition books can sell for huge amounts because wealthy buyers compete to own something that cannot be replaced. That is why the rarest items reach extreme prices. In 2022, a 1955 Mercedes-Benz 300 SLR Uhlenhaut Coupe sold for 135 million euros, mainly because only 2 were ever made. In 2017, Leonardo da Vinci's Salvator Mundi sold for $450 million. Not because of the paint or canvas, but because it is believed to be one of very few works by Da Vinci. Collectibles gain value because rich buyers see them as a way to store wealth, show status, and enjoy owning something unique. When money loses value, These buyers are often willing to pay much more in cash terms to secure rare items, which pushes prices higher, even though the item itself never changes. This asset class also has clear risks. Buyers need expert knowledge. Fakes are common, storage and insurance can be expensive, and prices can change as tastes shift. Still, new platforms now let smaller investors take part through shared ownership and organized marketplaces. The core idea is simple. When only one or two of something exist, and people with money want it, the price can rise to levels that seem unreasonable, because truly unique items can never be made again. These assets have survived every major currency collapse for simple reasons. They are hard to create, useful in the real world, backed by strong systems, or so rare that people still want them when money fails. History shows the pattern clearly. When Spain collapsed in the 1600s, gold and land held their value. When the British pound lost most of its buying power, the same assets protected wealth. Since 1971, as the dollar has steadily weakened, these assets have continued to hold or grow in real value. This isn't random. Money is only as strong as the government behind it. When money is printed to solve problems, its value falls, and wealth moves into assets that cannot be printed. That pattern is playing out again today. The question isn't if it continues, but whether you recognize it in time. If this helped you understand the system, like the video, subscribe, and share it with someone who should see this.